Good morning, folks. This is Miles Earhart here with Art Jetter and Company, joined with Jim with Illinois Mutual. So it is 10:30 right now. I do have a few more folks that I believe will be rolling in. So let's just sit tight for a few moments, and then we will get this one jump started here shortly. All right, we've had a few more folks roll in, so let's get this one started here. So thanks again for everyone joining us today. We're going to have a great webinar with Jim Cooney from Illinois Mutual. As you folks have questions, please type them in the question box on your control panel at the bottom right side of your screen. We'll answer them at the end of this presentation. And after the webinar, please give me a call to receive a copy of today's webinar and answer any additional questions that you may have. Once again, thanks for joining us. Jim, take it away.
All right. Well, thank you, Miles, and thanks everybody for joining us today. And it's always fun to be able to get in front of a group to talk about income protection. So again, like you said, my name is Jim Cooney. I am the regional sales manager for the West region of the United States with Illinois Mutual. I just represent the individual disability product with our group. So we're going to be talking a little bit about a little bit of foundational stuff with income protection, and then we'll get into a little bit more some ideas and a little bit of product and underwriting and so forth, what the process looks like. So this is myself. We don't have our cameras going today, but myself and my internal partner Erica. Obviously your first line of defense is always going to be the team at Art Jetter with Miles and his group, but if you do have things that you need to contact us directly, feel free to reach out. This is our contact information, both emails and phone numbers. So I always like to start presentations like this is kind of talking about, what is income protection, what is disability insurance. So I don't use the word disability. I really try to shy away from that. I tend to stick to income protection. It's a much less negative word, in my opinion, when you talk to individuals about this particular need. And this slide is probably the most telling slide that you could possibly have. Generally speaking, when we've got people that sell disability coverage, they're all over the board in terms of what they do as an advisor. You could be a PNC agent, you could be a life insurance agent, you could be a financial advisor with a small portion of your business being insurance, you could be a health producer. I mean, there's many different things that people do. There's not a ton of people that do disability as a specialty. So this is really an ancillary product, but it is an incredibly important ancillary product that advisors need to keep in their quiver of products that they talk about. And it really should be one of the very most foundational or first conversations that you have, because if you lose your paycheck, you're unable to fund or do any of the other things that you're putting in place for your clients, whether it's other insurance needs or whether it's retirement planning or savings or college savings or whatever the case may be. And then ultimately it's going to be a wealth transfer strategy, but we really need that paycheck to accomplish all of those things. So this is kind of where I want you guys to start thinking about this as we work through the material today, as to who you're going to be having this conversation with. And really, I use a very, very basic demographic when it comes to protecting income and who should you be talking to, which of your clients. And it's really 55 years old and younger. We can offer coverage all the way up through age 60 or up until the 61st birthday, actually. But really, generally speaking, that the conversation transfers from income protection around age 55 to a more of a long-term care solution, because you're going to get to the point where you're getting close to being funded for retirement and so forth. So, but 55 and younger, still working, and here's the key: you're not able to retire yet. So if you've got clients that potentially are business owners or well-to-do, they've got inheritance, they've saved a lot of money, whatever the case is, if they could retire right now, they don't need this coverage. but there's a lot of folks that don't meet those parameters, right? Most people have to work many people have to work into their late 60s and to their mid 70s to make ends meet. So that's who we're talking about. And if you think about those people, a lot of the folks that we're going to be talking about today are the people that can least afford to not have a paycheck. And these are a couple of really, really telling statistics. And I'm going to talk about where our company specializes, but right now, if you look at this particular slide, 63% of the American public would feel the financial pinch if their paycheck was delayed just a week. That's a really telling statistic. The one on the right is more disturbing than ever. 2/3 of our working population, if you remove the government employees, have no long-term disability insurance coverage whatsoever. So if they become sick or injured and they're unable to do their job, they have to rely on savings, family, or potentially the government. And since I've talked about the government, I'm just going to really quickly address what that potentially would mean. Now, as you guys probably know, there's two main sources that you could potentially get a benefit or a payment from Uncle Sam if you're unable to work. One of them is workers' compensation. And as you know, with workers' compensation, you have to be hurt on the job to be able to collect. Well, that's typically only 8 hours out of 24 in a day. So anything that happens outside of that is not going to be covered with workers' comp. The other potential solution would be with Social Security disability. To qualify for Social Security disability, it's incredibly difficult. You have to be totally disabled from any job in the national economy for 5 full months before you can even apply. You also will have to be deemed totally disabled for a full year by a physician to be eligible to apply. Then the clock starts ticking, and it typically takes about 2 years to get an answer from the Social Security Administration. We know people can't be without their paycheck for a week. They certainly can't be without a paycheck for 2.5 years. So those really aren't ideal solutions for your clients. So having an individual disability protection conversation is really, really important. And that's one of the main things about individual coverage is that it covers you 24/7 on the job, off the job, sickness or injury. And the target market that Illinois Mutual typically markets to is going to be household income of $200,000 or less. And a lot of the people that are in that middle market or middle America, the types of occupations that they're going to be in are going to be the types of jobs that don't typically provide or have corporate benefits, particularly long-term disability coverage. So you've got a lot of people that are in skilled trades. You can have, people like truck drivers. You can have people like dental hygienists, registered nurses, people like that. That a lot of, they're training, they're making a nice living, but a lot of times the companies that they work for, potentially even self-employed, don't offer that opportunity for group long-term disability coverage. So moving into some basics about disability insurance, or again, as I refer to it, income protection, there's really a few buzzwords that you guys are going to need to be familiar with, and it's also what you're going to need to know from your client. Number one, how much can I get? That's going to translate into a disability benefit. So individual policies will pay a tax-free monthly benefit to you as long as you're unable to work. Now, many policies, including ours, will have a partial benefit if you're able to do some portions of your work, but not all. Depending on which riders you choose, there's also something called a residual disability benefit that will provide a benefit through your benefit period that would be based on your loss of income. So there's a number of different things that a disability benefit discusses, but basically it's the monthly amount that you're going to be getting from the insurance carrier if you're unable to do your job. When does it start? Well, there's a trigger point with individual disability coverage called the elimination period. So you have to be unable to work for X amount of days before the insurance company will start sending you an income replacement check or a monthly tax-free check. That's the elimination period. Now, you can choose a shorter period, as you can see on here, some examples, 30, 60, 90, 180 days, or a full year. The longer you wait, obviously the insurance company is going to be less exposed to having to pay you, right? So the premiums are going to be less. The shorter you go, which is more attractive, obviously, to consumers, is going to drive a more expensive solution. But we already know that most of the American public needs to have that benefit start as quickly as possible. So we're going to typically skew towards the side of a shorter elimination period and maybe change a little bit of stuff on the other part of the solution to make it more budget friendly, because that's one thing that you as advisors need to keep in mind when you have this conversation with clients, is that a lot of consumers, and I might even say most, fail to see the value in protecting their paycheck. They should, but they don't. Everybody gets life insurance. Everybody's going to die. They all understand that. Not a ton of people will really respect the value, and that's going to be up to you as their advisor to really talk to them about that and why this is so important. So the elimination period is just going to be simply, how long can you go without that paycheck? And you can wait if you've got good savings, if you potentially have long-term disability coverage through your company, maybe you've got short-term disability through your company or personally. That's rare, but you potentially could. That's going to offer maybe 6 months of coverage. And then that's where your long-term disability kicks in. Well, if you wait a little bit longer time, obviously that's going to make the premiums a little bit cheaper. And then how long is that benefit going to last? How long would the insurance company pay you while you're unable to work? And that can go anywhere from an abbreviated period of like 2 years all the way out to retirement age. So the longer the insurance company would be on the hook, quote unquote, to pay you that monthly benefit, the more expensive those monthly premiums are going to be. The reality is, with disability, is that most disabilities or things that prevent people from working are short-term in nature. The average nationally of being out of work for people that submit claims is somewhere between 2.5 and 3 years. With most of the clientele that we work with, because it has more of a blue-gray collar tint, a lot of times there's going to be people that are going to be getting hurt on the job, and it typically tends to be something that's going to be shorter than that. But the bottom line is, we don't necessarily have to provide a solution that lasts all the way to retirement. Most disabilities are not catastrophic, they're short-term. So if you provide a benefit that's going to pay 2 years or 5 years or 10 years, that's going to be able to pay the vast majority of claims. So that's another way that we can combat that shorter elimination period by having a limited benefit period. And then the final word that we use, and I've already thrown this out, you guys all know it for being in this business, is premium. That's what the monthly cost is for your clients. So when you bring this conversation up, a lot of times you're going to have a number of different responses, or these are the 3 main things that your client is thinking why they're not going to buy this coverage. Number 1, it's not going to happen to me. Number 2, it costs too much. Or number 3, I've already got coverage through work. And we're going to address all 3 of those. So the first misnomer I like to kind of refer to it as is, most people envision or think about disability as somebody that's in a wheelchair, in a hospital bed, getting into a car wreck, falling off of a ladder, putting up your family Christmas lights, whatever the case may be, getting hurt on the job. The reality is that accidents themselves only represent, or injuries resulting from accidents, only represent about 8%. It's for us, it's a little bit higher than that. It's closer to 10%, but this is more of an industry-wide statistic. But a lot of these things, by and large, are going to be out of your client's controls. The biggest claim that we see is going to be neck and back problems, musculoskeletal, those types of issues, neck, back, knees, shoulders, hands, arthritis, carpal tunnel, all those sorts of things that prevent people from doing their job. Mental nervous is a big one. Nervous system is a big one. Cancers, heart attacks, strokes, right? All those sorts of things. Those are the things that are going to prevent people from doing their job. It's not necessarily getting into a car accident. The cost, it's too much, right? Well, if you think about this, generally speaking, I want you guys to either think about this, remember it, write it down, however you want to do it. But income protection, or paycheck protection, I sometimes call it, generally runs, from a cost perspective, somewhere between 1% and 3% of your gross income. So for example, If you think about somebody that's making $100,000 a year, their annualized premium is probably going to be somewhere between $1,000 and $1,500 per year, which is about $90 a month. That's the average cost for an income replacement solution for our clients. Obviously, the lesser amount, though, if you're skewing more towards the 1%, you're probably going to have less bells and whistles. It might have a less monthly benefit amount. The more coverage you get, obviously, the more expensive it's going to be, and there's a lot of other factors that are going to go into the cost of it. But this is reality. It's only about 1%, 1 to 2%, I think, is a good rule of thumb of your paycheck. I have coverage at work. It's not an excuse, it's just a comment, but you always want to be able to address it. And I always say that's, you react to something like that by saying that's great. And I'm gonna stop myself right there and just say, if only one spouse has coverage at work, unlike a lot of other group benefits, long-term disability is not part of that group. Like health insurance, dental insurance, vision insurance, even spousal life insurance, a lot of those benefits are available for spouses of employees. Long-term disability only applies to the employees themselves. So if they have that, just make sure you find out who's got coverage and what kind of coverage that they have. But this is a good reason why you can say, well, that's great. I'm glad you've got coverage at work. But generally speaking, those benefits are going to be provided by the companies that they work for, which means that if they become sick or injured and they're not able to work and they start collecting a monthly check, that check is going to be treated just like your paycheck, but it's going to be significantly smaller. So it's going to be fully taxable ordinary income. So this particular graphic, you're seeing somebody that's got a $75,000 a year salary. So that would be making $6,200, $6,250, excuse me, for before tax every month. You take out your federal and state income tax. We all know there's going to be more deductions other than that, but if we just look at federal and state taxes, you're probably going to have about 30% tax taken out. So your $6,250 is already down to $4,300. That's before, or that's when you're working full time. Most group long-term disability plans offer 60% of income replacement. So 60% of that $6,250 is going to bring you all the way down to $3,750. Then we all know that we have to pay taxes on that, right? So now you're down from $4,375 take home down to $2,600 per month. That is a huge, huge difference. You might be able to scrape by and pay your mortgage and some of your bills with $2,625, but you're certainly not going to be able to maintain lifestyle, and you most definitely will not be doing any sort of savings or funding any of those things on that pyramid that we saw at the beginning of the conversation. And what we can do as advisors is we can supplement that group coverage with an individual policy, tax exempt. So in this particular case, with this example, we would be able to add an additional $1,600 per month of individual coverage, tax-free, as you remember. That's going to get us up to a point where we're at 68% of your gross income versus healthy and working 70%. We almost filled or provided a solution for your entire paycheck by supplementing that group coverage. So that's really, really important that can put you in a really good place to not only pay the bills, but you're able to continue to save for retirement and pay those other things that that you've got in place as solutions for your clients. These are just some verbiages that I'm not going to really get into today, but individual policies that are issued by Illinois Mutual are considered guaranteed renewable. As long as you pay the bills, we're gonna continue to offer coverage to you. The non-cancelable part of that on the left there is just simply it's a rider that you can add to guarantee that the rates will never go up. We do reserve the right to raise the rates on everybody's policy in the same classification if you don't have that rider, but in reality we've only done it once in 110 years of our company. And that was on a book of a business or a block of business that we bought from another vendor that went bankrupt. So it's very, very unlikely to happen. And then conditionally renewable, most coverages or our base contracts will run up through age 67. And then at age 67, if you want to continue to working, you can keep your policy in place, but it becomes conditionally renewable. You have to continue working basically for us to continue to offer coverage to you. So those are just a couple of verbiages that I wanted you guys to be familiar with. So our two product lines, we just talked about individual disability. And by the way, that particular product, unlike group insurance, it's portable. So you own it, it goes with you from job to job. Even if you completely change occupations, that's a portable coverage. A second coverage that we provide to our homeowner or to our small business owners, not homeowners, to our small business owners is something called business overhead expense. And it's something that we can provide an additional monthly benefit to your small business owners that have additional expenses related to their companies. The one thing that I want to point out here is two things. Number one is that if you do both a DI and a BOE for your small business owners, you receive a 5% lifetime discount on the premiums. More importantly, the thing that's on the screen is the bottom bullet point that's highlighted a little bit, is that we offer not only on our individual disability policies, but on our business overhead policies, a return of premium rider. So if they own that policy or that coverage all the way up to age 67, they will receive 100% of their premiums back tax-free. And that business overhead expense premium to the business owner, as long as they can cash flow it, is a deductible expense. So here's a couple of examples of potentially some expenses that a small business owner is going to have. The biggest one that I want to point out on this particular screen is employee salaries. You can't replace your own salary as a business owner. That's what your individual DI coverage is for, but you can pay the salaries of your office manager, of your warehouse manager, or whoever you have that's working in the office that's going to be able to keep the doors open, the lights on, and all of those things while the owner hopefully gets better and is able to return to work within a couple of years. But things like, phones, utilities at the office, insurance premiums, car payments or leases, equipment leases, all those sorts of things. So this is just another coverage that you have available or you have access to for your small business owners. So what information is ArtJetter going to need, is Miles and his team going to need to be able to provide you a recommendation or recommendations? And I'll talk about that in a minute. So a couple of things is that you need the name, date of birth, sex or gender. And on that note, just FYI, unlike life insurance where men are more expensive than women, income protection, women are more expensive than men. We need to know what state they live in. We need to know their tobacco status. This says smoking. This is an old slide, but tobacco. So whether it's vaping, whether it's chewing tobacco, whether it's the nicotine patches, gum, anything that's going to trigger a positive response if somebody took a blood test, that's considered a tobacco user. So we need to know that status. We need to know how much money they're making. We need to know what they do for a living. And we need to know if they've got any other income protection coverage in place. Most likely it's going to be through group, but there is occasional you'll run into somebody that's already got, maybe an individual DI policy they bought years ago, but their income is significantly higher. They just want to add to it. And the one note that I want to make here, the income portion of this slide, we talked about offering coverage to small business owners. So keep in mind that small business owners, when we say what is their income, that doesn't mean company revenue. What it means is that it's going to be a combination of typically two things. One is how much money they pay themselves, W-2. This is in the eyes of an underwriter or an insurance company. And then two, what is their portion of ownership of net company profits? And when I say net, I mean net after expenses before taxes. So what are they paying taxes on for their portion of that ownership, whether it's 100% ownership or whether it's a 25 ownership or whatever the case is, whatever flows through to them, either on a Schedule C or a Schedule E or potentially a K1, depending on how the company is incorporated. Those two things combined is going to create what their income is. And the solution that ArtJetter is going to be able to provide to you for your clients is going to be based off of that income, and it's going to be based off of their age and off their occupation. All of these things going into determine what the final cost is going to be for your clients. So just like life insurance, obviously, the more benefit you're going to have, the more expensive. The older you are, the more expensive. We already know that women are more expensive, but occupations drive a pretty large portion of the cost of income protection coverage. And what we have is something called occupation classes. So occupation classes, they vary by insurance company or by the vendors, but they are typically in a scale from either 1 to 5 or 1 to 6. A 1 being a more dangerous or physically laborious type of a job, and then a 5 or 6 is going to be your least amount of risk exposure at your occupation or at your job. So you guys are all going to be considered that top occupation class. Somebody that sits at a desk, somebody that's in HR, marketing, IT, finance, all those people are going to be considered the top occupation classes in our eyes. The lower occupation classes are going to be people that are going to be in more dangerous, potentially, occupations or more labor intensive type where there's a lot more manual duties. And I use an example of like a police officer or a firefighter. Those are going to be your 1s. So the higher risk occupations are typically they're gonna be getting a lesser amount of coverage, or just simply to reduce the exposure, because we know they're very likely to become sick or injured or whatever on the job just because of what they do. Typically, insurance companies are just going to limit the amount or types of coverage that they're going to provide. So all of these things combined generate an application, which just leads me into a real quick underwriting. There's an underwriting component. You will take an application for everybody, and then based on their amount of monthly benefit that they want and the amount of or the amount of financial documentation that would be required, we might have to know that they're making $100,000 via a pay stub, a W-2, tax returns if you have a business owner, those sorts of things. Those could potentially trigger additional financial documentations. Ours are 50 years old and older. You're going to have to take a ParaMed exam, or if you're applying for $5,000 per more of monthly benefit, that would also trigger a ParaMed exam. And then the financial documentation is going to be based on whether you're W-2 or whether you're self-employed. So to quickly transition now into some potential opportunities for you guys to think about, Illinois Mutual really target markets that middle America. And what we do is we have some specific marketing pieces for occupations that you guys can capitalize on. And a lot of those specific occupations also have associations that many of those people doing those jobs are members of. So whether it's the Dental Hygienists Association of Greater Colorado or the Long Haul Truckers Association of Des Moines, or whatever the case is, if you know of somebody, potentially even a former job of your own, maybe a spouse, a family member, buddies, if you've got connections of people that are in one of these types of jobs, that's a really good conduit for you guys to get into potentially an association or any of their peers that you could potentially market to. And we've got specific things for all these different occupations. And we have like marketing letters, emails, we have social media things that we use that you can put on your feeds, whether it's LinkedIn or Facebook or whatever the case may be, that would be specific to these different occupations. We've actually got more than this. I think we've got like 19 of these now, but this is a great way for you guys to go out and solicit this business. And on this page, I always like to point out this one as an opportunity. The bottom left, you see truck drivers, so long haul over the road truckers. I tended to like to use the example of a need for both individual disability and for business overhead expense. And if you know of any of those guys or women, they're almost all self-employed and they almost all own their own tractor. They just hook into somebody else's Walmart or Amazon's or whoever it is to their goods in their trailers, and they pull them across the country. Well, if you think about it, if they're not able to drive and they're not able to do that, their paycheck goes away, right? But you know what? They own these multi-$100,000 tractors that are or that they need to drive to pay for it. So that's a great example of where you could have business overhead expense coverage for that small business owner truck driver have an individual policy to replace their income if something happens to their back or their neck or their vision or whatever the case may be, where they're not able to drive, and they're still able to pay that bank for up to 2 years until they either A, get better, or B, they'll have to, end up being forced to sell their vehicle. From a compensation standpoint, this is just something I like to throw out. If you do have a business owner opportunity where you can put in multiple applications or multiple families, but you can get up to $900 every quarter through Illinois Mutual over and above any of the base compensation that you'd be paid on. So that's always something that I like to point out. So one thing too is that coming up in a couple of months in May is something called the Disability Income Awareness Month, or DIAM. And I'm sure that's something that Miles and his group will market and talk about. But from an Illinois Mutual perspective, we pay an additional $100 for every application that you submit in the month of May in addition to that. So finally, you can lean 100% on Miles and his team. If you really don't want to dive in deep on your own and do your own homework and do your own illustrations and all that kind of stuff, if you are interested in the marketing side of things, you can work with Erica, my internal, or myself. We can do training on doing e-applications. We can train you to get, or we will get you registered on our advisor website, which is called the Agent Forum. And that's where you can do all kinds of stuff, from illustrations to compensation to e-applications and e-signatures, all that marketing stuff, like those specific occupations and stuff like that. So that's really all I had for today. I want to thank you, number one, for you guys for spending a few minutes with Miles and myself. And then I'll just throw it back to Miles to see if we've got any questions that potentially came through for either you or me.
Absolutely, Jim. That is awesome information. Thank you for presenting that. And we did have a few questions roll through. So let's just, in one you just actually spoke about. So does Illinois Mutual marketing materials such as flyers and mailers? So I don't know if you could pull that page back up quickly.
Yeah, I mean, this is where you would get it, but the stuff that you can do, I mean, all this kind of stuff is in there. These are just specific occupation examples, but we've got everything that you need, whether it's real basic stuff that you can put on your desk, just have a supply of them. We have something called the Simple as 1, 2, 3. It's a consumer-based flyer that you can have to give out to your consumer clients that just explain what income protection is. But absolutely, but all that stuff you can find on this website.
Perfect. And then another question got posed about the return of premium rider.
Yep. So again, you can get that both on our business overhead expense and our individual policies. And just to kind of touch on the specifics about it, you have to own your policy for a full 4 years before you're able to start to collect on that particular feature of the policy or that particular rider. In order to get all of your money back, you have to own the policy all the way to age 65. Okay, it doesn't have to be to 67, but to 65. As long as you own that policy, you will get 100% of your premiums back, less any benefit that we would have paid out along the way if you did become disabled. So it's a great benefit. And the same with business overhead expense. It'll pay you back 100% tax exempt or tax free your benefit at age 65. If between having owned it for 4 years and 65 and you decide to get rid of the coverage because maybe retirement's become fully funded, it would just simply be on a scale. The longer you own it, the higher the percentage of return of premium. So if you only own it 5 years, you're probably going to only get about 10% of your premiums back. If you own it for 20 and so forth, it just goes up. And there's a grid that we have that you could have access to if you're interested. But that's basically how it works.
Perfect. And yeah, honestly, with all the agents that I speak with, I try to talk about that return of premium. If it's affordable, if it's something that's within the budget, I think it's a great opportunity for the client
without a doubt
recruit that. So,
Yep.
And then another question from Robbie. Can you repeat the portion of ownership definition?
So that's just basically, that's going to be, if you're looking at small business owners, typically they're going to have a percentage of ownership of a company. That would be their portion of ownership of profits, right? So that's how we would recognize two things. Number one, what percentage of that company's net operating profits are attributed to each particular owner. So that's just going to be a percentage that's going to be in their ownership agreement. And then the second one would be business overhead expense. So if you've got a dental practice and you've got 3 dentists, let's say, each of them own a third of that practice, and you've got, $30,000 a month of business overhead expenses total, each of them have to pay $10,000. They would only qualify for that $10,000 per month of business expenses that they'd be able to collect on with that other policy. So hopefully that makes sense. And one other thing I want to point out too, that with most clients, because of the sensitivity of price with protecting paychecks, we typically come up with 2 different solutions. And Miles, I don't know if you guys use this strategy or not, but typically, we like to say, this is what you qualify for, this is what it would cost. And, we need to do something, maybe here's something a little bit more stripped down, maybe a little less benefit. Maybe you meet in the middle somewhere to fit a budget, because you might not need that entire amount, but we always want to know, what do you qualify for, and then what makes sense for you for a solution. And that's where you need to know your clients, know how budget sensitive they are, know how comprehensive, know how receptive they are to insurance and all those sorts of things before you just put a solution in front of them, because there can be a little sticker shock, certainly as Miles knows, with providing these solutions.
Absolutely. That's why one thing when I do talk with my agents, I say budgets, where a lot of them don't have a clear idea of what they're really looking for to pay. But if you get a good idea of the budget, you can really narrow down the benefits, the elimination benefit period, things like that. So
Yep.
That is a good conversation to have. And then one more, will this work for 1099 contractors?
It absolutely will, and that's actually where a lot of our coverage or our policy placements come from. And those guys are just technically considered self-employed, right? So if you're an IT person working as a 1099 or a contractor, absolutely. Whether you're a mortgage broker, whether you're a realtor, those are all people, because they're 1099, they're self-employed, and they have no access to corporate benefits, right? Those are great people to think about. If you know those people, like a realtor is an example of somebody that we've got one of those flyers for. If you know those types of people, they absolutely are covered. Now, the one thing I want to warn you about is, again, it's not revenue that's based on, that's not their income. That's their revenue. Their insurable income is going to be their revenue minus expenses from the company. So realtors are classic for writing off everything under the sun. So if they say they made 300 grand, they probably made 100. From Uncle Sam's perspective, and that's the number that we need to know. So absolutely, we covered 1099s.
Perfect. Very good answer. And then no more questions, but I did have a few people. Thank you for the awesome presentation there, Jim. So right. I don't see anything popping up on this end, but I guess once again, Jim, thank you for the time. Like I said, really good presentation, a lot of good information here. If you agents have any questions at all, you can give us a call or email at di@jetter.com. Really simple email there, di@jetter.com. So reach out, give us a call, and we can get to work at any point on any folks, any clients that you're working with there. So.
All right, sir. Thank you very, very much. Thanks everybody for joining us. Have a great rest of your day.
Thanks, folks. Take care.